Do you want to successfully complete the D775 Objective Assessment exam? Then you are in the right place. Our website provides a list of questions and answers for your success in the D775 OA exam for free. We understand that acing your OA exam can be quite challenging. That's why we provide completely free exam guides and practice questions for you. In this video, we will cover questions from capital budgeting, financial ratio analysis, time value concepts, capital structure, and risk and return. So let's get started. 1. A manufacturing company needs to decide whether to build a new production facility that requires significant upfront investment but promises long-term cash flows. Which financial professional would primarily be responsible for analysing this decision using mathematical models and time value concepts? A. Financial accountant. B. Finance analyst. C. Tax accountant. D. Compliance auditor. Can you guess the answer? Correct answer, B. Finance analyst. Explanation: option B is correct because finance analysts use mathematical models and time value of money concepts to evaluate capital investment projects, making them responsible for analysing whether projects like new facilities should be undertaken. Option A is incorrect because financial accountants focus on recording and reporting historical transactions rather than making forward-looking investment decisions using mathematical models. Option C is incorrect because tax accountants specialise in tax compliance and planning, not in evaluating capital investment projects using time value of money concepts. Option D is incorrect because compliance auditors ensure adherence to regulations and standards rather than analysing investment opportunities using financial models and projections. Alright, let's break down the core concept behind this question. In business, we have two distinct roles: accountants and finance analysts. When a manufacturing company needs to decide whether to build a new production facility, they're facing a major capital investment decision. This requires looking into the future and evaluating whether the long-term cash flows justify the upfront cost. Finance analysts specialise in exactly this type of work. They use mathematical models like net present value and time value of money concepts to assess whether projects will create value for the company. Financial accountants, on the other hand, focus on recording what already happened and ensuring compliance with standards. Tax accountants handle tax planning and compliance, while compliance auditors check that regulations are being followed. So when you need someone to analyse future investments using financial models, you need a finance analyst. 2. Two retail stores have identical revenue figures, but Store A maintains detailed records of past transactions, while Store B develops growth strategies for future expansion. Which aspect primarily differentiates their approaches? A. Regulatory compliance levels. B. Primary user groups. C. Decision-making authority. D. Time orientation differences. Do you know the answer? Correct answer, D. Time orientation differences. Explanation: option D is correct because Store A focuses on historical data recording, while Store B focuses on future planning, representing the fundamental difference between accounting's past orientation and finance's future orientation. Option A is incorrect because both stores must comply with regulations. The difference lies in whether they focus on historical reporting or future planning, not at compliance levels. Option B is incorrect because while accounting and finance serve different users, the scenario specifically highlights the temporal focus difference between recording past events and planning future growth. Option C is incorrect because decision-making authority relates to organisational structure, not to the fundamental distinction between recording historical transactions and creating forward-looking strategies. Let's explore the fundamental difference between accounting and finance through this scenario. We have two retail stores with identical revenues, but they operate very differently. Store A spends its time maintaining detailed records of past transactions, documenting what happened yesterday, last week, and last month. This is the essence of accounting. Store B, however, is focused on developing growth strategies for future expansion, planning where to open new locations, and how to increase market share. This is the essence of finance. The key distinction here is time orientation. Accounting looks backward at historical data to ensure accuracy and compliance. Finance looks forward, using data to make predictions and strategic decisions. Both stores need to comply with regulations and serve various users, but the scenario specifically highlights the temporal difference. One is recording history, the other is planning the future. This time orientation difference is what fundamentally separates accounting from finance in the business world. 3. A tech startup has current assets worth $2 million and current liabilities of $3 million. What financial health concern would this ratio immediately signal to potential creditors? A. Profitability concerns. B. Market valuation issues. C. Liquidity trouble. D. Efficiency problems. Can you guess the answer? Correct answer, C. Liquidity trouble. Explanation: option C is correct, because a current ratio below 1 indicates the company cannot cover short-term obligations with current assets, signalling potential liquidity problems to creditors and stakeholders. Option A is incorrect because profitability ratios measure earnings generation, not the ability to pay short-term bills, which is specifically indicated by liquidity ratios like current ratio. Option B is incorrect because market valuation issues relate to how investors price the company's stock, not to its ability to meet immediate financial obligations with available assets. Option D is incorrect because efficiency problems are revealed through activity ratios measuring asset utilization, not through the relationship between current assets and current liabilities. This is a critical concept for understanding liquidity ratios. Picture a tech startup that has $2 million in current assets, things like cash, inventory, and accounts receivable. Now they owe $3 million in current liabilities, meaning bills that need to be paid within the next year. When we divide current assets by current liabilities, we get what's called the current ratio. In this case, 2 divided by 3 gives us approximately 0.67, which is below 1. Here's why this matters. A current ratio below 1 means the company doesn't have enough liquid assets to cover its short-term debts. If all the creditors came knocking tomorrow asking for payment, the company couldn't pay them with what it has on hand. This is a classic liquidity problem. It's not about whether the company is profitable or has good market value. Those are different metrics entirely. Liquidity specifically refers to the ability to meet short-term obligations. And when your current ratio is below 1, creditors see a red flag that you might struggle to pay your bills. 4. A restaurant chain converts its inventory to sales 12 times annually, while a competitor only achieves 6 turnovers. What does this difference primarily indicate about the first chain's operations? A. Higher debt levels. B. Greater efficiency. C. Better profitability. D. Stronger market position. Do you know the answer? Correct answer, B. Greater efficiency. Explanation: option B is correct, because higher inventory turnover demonstrates that the restaurant converts inventory to sales more quickly, indicating more efficient asset utilization and better operational management of resources. Option A is incorrect because inventory turnover measures how efficiently assets generate revenue, not the company's debt levels, which are assessed through leverage ratios instead. Option C is incorrect because while efficiency can contribute to profitability, turnover specifically measures operational efficiency in converting assets to sales, not profit margins or earnings. Option D is incorrect because market position relates to competitive standing and valuation, whereas inventory turnover specifically measures the efficiency of asset utilization in operations. To really understand efficiency ratios, let's dive into this restaurant scenario. Imagine two restaurant chains selling similar food. The first chain converts its inventory to sales 12 times per year, meaning every month they completely turn over their stock. The competitor only achieves 6 turnovers annually, taking 2 months to sell through their inventory. This difference reveals operational efficiency. The faster chain's getting products from the kitchen to customers more quickly, reducing waste and keeping fresher ingredients. Inventory turnover is an activity ratio that measures how efficiently a company uses its assets to generate sales. High turnover means the restaurant is managing inventory well, not over-ordering, and moving products quickly. This isn't about debt levels, which leverage ratios measure. It's not directly about profit margins, though efficiency helps profitability, and it's not about market position or brand strength. Inventory turnover specifically tells us how well the company converts assets into revenue, making it a pure efficiency indicator. 5. A homeowner has a mortgage representing 80% of their property value. In corporate finance terms, what characteristic does this situation best illustrate? A. High diversification. B. Strong liquidity. C. High leverage. D. Low efficiency. Can you guess the answer? Correct answer: C. High leverage. Explanation: Option C is correct because high leverage means using substantial debt relative to assets or equity, just as the homeowner has a large mortgage relative to property value. Option A is incorrect because diversification relates to spreading investments across different assets to reduce risk, not to the proportion of debt used to finance assets. Option B is incorrect because liquidity refers to the ability to quickly convert assets to cash or meet short-term obligations, not to the degree of debt financing. Option D is incorrect because efficiency measures how effectively assets generate revenue, whereas leverage specifically refers to the use of debt financing relative to equity or assets. Let's connect personal finance to corporate finance through this leverage concept. Imagine a homeowner who bought a house worth $100,000 but took out an $80,000 mortgage. That means 80% of the property is financed by debt, and only 20% represents the owner's actual equity or down payment. In corporate finance, we call this high leverage. Leverage simply means using debt to finance assets. When a company or individual uses a lot of borrowed money relative to their own money, they're highly leveraged. This is completely different from diversification, which is about spreading investments across different assets to reduce risk. It's not about liquidity, which measures how quickly you can convert assets to cash. And it's not about efficiency, which measures how well assets generate revenue. High leverage specifically describes the proportion of debt in your capital structure. The homeowner with an 80% mortgage is just like a company with high debt to asset or debt to equity ratios. 6. Two coffee shops sell identical beverages at the same prices, but shop A consistently generates higher net income. What aspect of their operations most likely explains this difference? A. Location advantage. B. Cost management. C. Customer loyalty. D. Brand recognition. Do you know the answer? Correct answer: B. Cost management. Explanation: Option B is correct because if revenues are identical, but one shop earns more, the difference must come from lower costs, demonstrating superior cost management and operational efficiency. Option A is incorrect because location advantage typically affects revenue generation through customer traffic, but the scenario states both shops have identical sales figures. Option C is incorrect because customer loyalty would primarily impact revenue levels and repeat business, yet both shops already have identical revenue in this scenario. Option D is incorrect because brand recognition influences revenue and pricing power, but since both shops have identical sales, the profit difference must stem from costs. Here's an interesting profitability puzzle to solve. Two coffee shops are selling identical beverages at exactly the same prices, and they're both bringing in the same total revenue. Yet shop A is walking away with significantly more net income, more profit at the end of the day. How is this possible if their sales are identical? The answer lies in cost management. Net income equals revenue minus costs. If revenue is the same for both shops, but shop A has higher net income, then shop A must have lower costs. Maybe they negotiated better deals with suppliers. Maybe they waste less coffee. Maybe their rent is lower. Or perhaps they schedule staff more efficiently to reduce labour costs. Cost management is about controlling expenses without sacrificing quality. This isn't about location advantage because location affects how much revenue you generate through foot traffic. It's not about customer loyalty or brand recognition, because those factors would create revenue differences, not profit differences when revenue is already equal. When revenues match but profits don't, always look at the cost side of the equation. 7. Two technology firms report identical annual profits, yet one trades at significantly higher stock prices. What factor most likely drives this valuation difference? A. Historical performance. B. Asset ownership. C. Growth expectations. D. Debt levels. Can you guess the answer? Correct answer, C. Growth expectations. Explanation. Option C is correct because market ratios reflect investor expectations about future performance. So higher stock prices, despite identical current profits, indicate greater anticipated growth and future earning potential. Option A is incorrect because historical performance is already reflected in the identical current profits. The price difference must come from forward-looking expectations, not past results. Option B is incorrect because while assets affect company value, market valuation differences with identical profits typically stem from differing growth prospects rather than current asset holdings. Option D is incorrect because debt levels affect financial risk, but don't fully explain why investors pay more for one company. Growth expectations primarily drive valuation premiums. This question explores how the stock market values companies beyond just current profits. Imagine two technology firms that just released their annual reports and both made exactly $1 million in profit this year. Yet when you look at their stock prices, Company A trades at $50 per share, while Company B trades at $100 per share. Why would investors pay twice as much for Company B if the profits are identical? The answer is growth expectations. Stock prices aren't just about today's earnings. They reflect what investors believe about tomorrow's earnings. Maybe Company B is developing breakthrough technology, entering new markets, or has a proven track record of doubling profits every few years. Investors are willing to pay more today because they expect much higher profits in the future. Historical performance is already baked into current profits. Asset ownership matters, but doesn't fully explain the price difference. Debt levels affect risk, but growth expectations are what primarily drive valuation premiums. The market pays for potential, not just present reality. 8. A company's balance sheet shows $5 million in total assets, equaling $2 million in liabilities, plus $3 million in equity. What fundamental accounting principle does this demonstrate? A. Revenue recognition. B. Matching principle. C. Accounting equation. D. Going concern. Do you know the answer? Correct answer, C. Accounting equation. Explanation. Option C is correct because the accounting equation states that assets must equal liabilities plus equity, which is exactly demonstrated by this balance sheet, showing $5 million equals $2 million plus $3 million. Option A is incorrect because revenue recognition governs when revenues are recorded in the income statement, not the fundamental relationship between assets, liabilities, and equity on balance sheets. Option B is incorrect because the matching principle relates to aligning expenses with related revenues in the income statement, not to the balance sheet equation structure. Option D is incorrect because going concern assumes business continuity, not the mathematical relationship requiring assets to equal the sum of liabilities and equity on balance sheets. Now we need to understand one of the most fundamental principles in all of accounting, the accounting equation. Look at this company's balance sheet. They have $5 million in total assets, things like cash, equipment, and inventory. On the other side of the balance sheet, they show $2 million in liabilities, money they owe to creditors, and $3 million in equity, which represents the owner's stake in the business. Notice that $5 million equals $2 million plus $3 million. This is not a coincidence, this is the accounting equation in action. Assets must always equal liabilities plus equity. Why? Because every dollar of assets a company has must come from somewhere. Either it came from borrowing, which creates liabilities, or it came from owners investing their own money, which creates equity. The balance sheet must always balance. This has nothing to do with revenue recognition, which is about when to record sales. It's not the matching principle, which pairs expenses with revenues. And it's not about going concern assumptions. The accounting equation is the mathematical foundation that makes double-entry bookkeeping work. 9. A financial statement shows revenues, expenses, and resulting net income over a 12-month period. Which statement type does this describe, and what does it primarily measure? A. Balance sheet measuring position. B. Income statement measuring performance. C. Cash flow measuring liquidity. D. Equity statement measuring ownership. Can you guess the answer? Correct answer. B. Income statement measuring performance. Explanation. Option B is correct because the income statement reports revenues, expenses, and net income over time, measuring the company's financial performance and profitability during a specific period. Option A is incorrect because balance sheets show financial position at a single point in time with assets, liabilities, and equity, not performance over a period. Option C is incorrect because cash flow statements track cash movements in and out, not the comprehensive revenue and expense structure that determines net income. Option D is incorrect because equity statements show changes in ownership interests, not the comprehensive revenue, expense, and profit performance over a reporting period. Let's clarify the difference between two critical financial statements. A company prepares a document showing revenues, expenses, and the resulting net income over a 12-month period. This is describing the income statement, and what it measures is performance. Think of it this way. The income statement is like a movie. It shows what happened over time. It starts with the revenue the company earned during the year, then subtracts all the expenses incurred during that same period, and arrives at net income or profit. This measures how well the company performed financially over those 12 months. In contrast, a balance sheet is like a photograph. It captures one moment in time, showing what the company owns and owes right now. The balance sheet measures position, not performance. A cash flow statement tracks how cash moved in and out, focusing specifically on liquidity. An equity statement shows changes in ownership interests. But when you see revenues, expenses, and net income over a time period, you're looking at an income statement measuring operational performance. 10. A manufacturing firm needs to improve its ability to meet short-term payment obligations. What immediate action would most directly address this liquidity concern? A. Issue new equity. B. Speed up receivables collection. C. Purchase new equipment. D. Increase advertising spending. Do you know the answer? Correct answer. B. Speed up receivables collection. Explanation: option B is correct because accelerating receivables collection converts credit sales to cash faster, directly improving liquidity by increasing available cash to meet short-term obligations without adding new financing. Option A is incorrect because while issuing equity raises capital, it's a longer-term solution, involving significant costs and processes, not the most immediate action for liquidity. Option C is incorrect because purchasing equipment actually reduces liquidity by converting cash into fixed assets, worsening rather than improving the ability to meet short-term obligations. Option D is incorrect because increasing advertising spending depletes cash resources, harming liquidity rather than improving the company's ability to meet immediate financial obligations. This scenario tests your understanding of liquidity management in action. A manufacturing firm is struggling to meet its short-term payment obligations. They need cash now to pay suppliers, employees, and other bills. What's the most direct solution? Speeding up receivables collection. Here's how it works. When a company sells products on credit, customers don't pay immediately. The company is owed money, but that money is tied up in accounts receivable. By encouraging customers to pay faster, perhaps by offering a small discount for early payment, the company converts those receivables into actual cash much more quickly. This directly improves liquidity without requiring any new financing. Issuing new equity would raise money, but it's a lengthy, expensive process involving lawyers and regulatory filings. Purchasing equipment actually makes liquidity worse because you're spending cash to buy assets that can't easily be converted back to cash. Increasing advertising spending drains cash even further. The fastest, most direct way to improve liquidity is to accelerate the conversion of existing receivables into cash. 11. A construction company shows declining return on equity over 3 consecutive years despite stable revenues. What strategic change would most effectively address this profitability concern? A. Reduce workforce size. B. Improve project selection. C. Increase debt financing. D. Expand geographically. Can you guess the answer? Correct answer: B. Improve project selection. Explanation: option B is correct because better project selection means choosing higher return projects that improve profitability, directly addressing declining return on equity by generating more profit from the same revenue base. Option A is incorrect because while reducing workforce might cut costs, it doesn't ensure improved returns. Poor project selection could still yield low profits, even with lower costs. Option C is incorrect because increasing debt changes capital structure but doesn't address the underlying profitability problem. It might temporarily boost return on equity through leverage effects. Option D is incorrect because geographic expansion doesn't solve profitability issues. Expanding with poor project selection would simply replicate the problem in new markets. This question is about diagnosing and fixing profitability problems. A construction company has a troubling pattern. Return on equity has been declining for 3 consecutive years, even though revenues remain stable. Return on equity measures how much profit the company generates for every dollar of shareholder equity. If revenues aren't changing but return on equity is dropping, it means the company is making less profit from the same amount of sales. The most effective solution is to improve project selection. Construction companies don't have to accept every project that comes their way. Some projects have thin profit margins due to intense competition or difficult conditions. Others offer much better returns because of specialized expertise or favorable terms. By being more selective and choosing projects with higher profit potential, the company directly addresses the profitability problem. Reducing workforce might cut costs, but could also hurt the ability to complete quality projects. Increasing debt financing changes the capital structure, but doesn't solve the underlying profitability issue. Geographic expansion without better project selection just spreads the problem to new locations. Better project selection targets the root cause, earning better returns on the work you do. 12. A retail business wants to increase cash collections to improve liquidity. What incentive structure would most effectively encourage faster customer payments? A. Extended payment terms. B. Bulk purchase discounts. C. Early payment discounts. D. Loyalty reward points. Do you know the answer? Correct answer, C. Early payment discounts. Explanation. Option C is correct because offering discounts for early payment, such as 2% off if paid within 10 days, directly incentivizes customers to pay faster, improving cash collections and liquidity. Option A is incorrect because extended payment terms actually slow down collections by giving customers more time to pay, harming rather than helping liquidity. Option B is incorrect because bulk purchase discounts encourage larger orders but don't specifically accelerate payment timing, which is the key to improving liquidity through collections. Option D is incorrect because loyalty points reward repeat purchases but don't create urgency for faster payment, failing to directly address the timing of cash collections. Let's explore a practical liquidity management strategy. A retail business wants to increase cash collections to improve their ability to pay bills and meet obligations. The most effective tool is early payment discounts. Here's the psychology and math behind it. If you tell customers they can have 2% off the total bill by paying within 10 days instead of the usual 30 days, many will take that deal. From the customer's perspective, saving 2% is attractive. From the business's perspective, getting cash 20 days earlier dramatically improves liquidity. This is a direct incentive that encourages faster payment. Extended payment terms do the opposite, giving customers more time to pay, which hurts liquidity. Bulk purchase discounts encourage larger orders, but don't speed up when customers actually pay. Loyalty reward points incentivize repeat business, which is great for long-term relationships, but they don't create urgency around payment timing. Early payment discounts directly link financial benefits to faster cash collection, making them the most effective liquidity tool. 13. A software company has a debt-to-equity ratio that has risen significantly over 2 years. What action would most directly reduce this financial risk indicator? A. Launch new products. B. Use profits to repay debt. C. Hire more developers. D. Acquire a competitor. Can you guess the answer? Correct answer, B. Use profits to repay debt. Explanation. Option B is correct because using profits to pay down debt directly reduces the debt amount in the debt-to-equity ratio calculation, immediately lowering financial risk and improving the balance sheet. Option A is incorrect because launching new products might generate future profits, but doesn't directly reduce the existing debt-to-equity ratio. It's an indirect, uncertain approach. Option C is incorrect because hiring more developers increases expenses and might reduce profits available for debt repayment, potentially worsening rather than improving the ratio. Option D is incorrect because acquiring a competitor typically requires taking on more debt, which would increase the debt-to-equity ratio rather than reduce this financial risk. Here's a risk management scenario involving leverage ratios. A software company's debt-to-equity ratio has risen significantly over 2 years. Remember, debt-to-equity compares how much the company owes to creditors versus how much the owners have invested. A rising ratio means debt is growing faster than equity, which increases financial risk. If the ratio gets too high, the company becomes vulnerable to economic downturns because they have heavy debt obligations to service. What's the most direct solution? Use profits to repay debt. When the company makes a profit, management has choices about what to do with that money. They can reinvest it, pay dividends to shareholders, or use it to pay down debt. By applying profits to debt repayment, the company directly reduces the numerator in the debt-to-equity ratio, bringing the ratio back down. Launching new products might generate future profits, but doesn't immediately reduce existing debt. Hiring more developers increases expenses and might reduce available profits. Acquiring a competitor typically requires taking on even more debt, making the problem worse. The direct path to lowering the debt-to-equity ratio is using current profits to reduce current debt. 14. An analyst compares a company's operating profit to its interest payments and finds the profit covers interest 7 times. What financial strength does this indicate? A. High market valuation. B. Strong debt coverage. C. Efficient operations. D. Rapid growth. Can you guess the answer? Correct answer, B. Strong debt coverage. Explanation. Option B is correct because a times interest earned ratio of 7 means operating profit covers interest obligations 7 times over, demonstrating strong ability to service debt and low default risk. Option A is incorrect because market valuation relates to stock prices and investor expectations, not to the relationship between operating profits and interest payment obligations. Option C is incorrect because while the company is profitable, the times interest earned specifically measures debt service capacity, not overall operational efficiency in generating revenue. Option D is incorrect because rapid growth relates to expansion rates and revenue increases, not to the company's ability to cover interest obligations with operating profits. Let's decode what the times interest earned ratio tells us about financial strength. An analyst looks at a company's operating profit and its interest payments and finds that the profit covers interest 7 times over. This is the times interest earned ratio, and it's a powerful indicator of debt coverage ability. Here's what it means. If the company's operating profit is $700,000 and their annual interest expense is $100,000, they can pay that interest 7 times before running out of operating profit. This shows strong ability to service debt obligations. Even if business slows down and profit drops significantly, they still have a comfortable cushion. This ratio isn't about market valuation, which relates to stock prices. It's not primarily about operational efficiency, though profitable operations certainly help. And it's not directly about growth rates. Times interest earned specifically measures how well operating profit covers interest obligations, making it a debt coverage strength indicator. The higher the ratio, the more confident creditors can be that interest payments will be made even in tougher times. 15. A restaurant business shows low profit margins compared to competitors despite similar revenue levels. What operational improvement would most directly address this profitability gap? A. Expand seating capacity. B. Reduce food waste. C. Extend operating hours. D. Renovate dining areas. Can you guess the answer? Correct answer, B. Reduce food waste. Explanation. Option B is correct, because reducing food waste directly lowers costs without affecting revenue, thereby improving profit margins by increasing the gap between revenues and expenses in operations. Option A is incorrect because expanding seating capacity involves capital investment and might increase revenues, but doesn't address the cost management issue causing low margins. Option C is incorrect because extending hours increases both revenues and costs. It doesn't directly address the margin problem of having higher costs relative to revenue. Option D is incorrect because renovation is a capital expenditure that doesn't directly reduce operating costs. Improved aesthetics might boost revenue, but not necessarily margins. This is a practical profitability improvement scenario. A restaurant business is earning similar revenues to its competitors, but its profit margins are noticeably lower. Profit margin is calculated by dividing net profit by revenue, so if revenue is comparable, but margin is lower, the problem is on the cost side. What's the most direct operational improvement? Reducing food waste. In the restaurant industry, food waste is a massive cost problem. When ingredients spoil, when plates come back half-eaten, when portion sizes are poorly controlled, the restaurant is essentially throwing money in the garbage. By implementing better inventory management, portion control, and food preparation processes, the restaurant reduces costs without touching revenue. This directly widens the profit margin. Expanding seating capacity is a capital investment that might increase revenues, but doesn't address the margin problem. Extending operating hours increases both revenues and costs, with uncertain impact on margins. Renovating dining areas is expensive and doesn't directly reduce operating costs. Reducing food waste is a pure cost reduction strategy that directly attacks the margin problem. 16. A manufacturing business needs to evaluate whether investing $1 million today in new equipment will generate sufficient future returns. Which core financial concept would guide this decision? A. Historical cost principle. B. Time value of money. C. Revenue recognition. D. Materiality threshold. Do you know the answer? Correct answer, B. Time value of money. Explanation: option B is correct because time value of money recognizes that money today is worth more than the same amount in the future, making it essential for comparing current investments with future returns. Option A is incorrect because historical cost records assets at purchase price, which is an accounting principle for reporting, not a tool for evaluating investment returns. Option C is incorrect because revenue recognition determines when to record sales in financial statements, not how to evaluate whether future equipment returns justify current investment. Option D is incorrect because materiality determines what information is significant enough to report, not how to assess whether future cash flows justify present-day capital investments. This question gets to the heart of capital investment analysis. A manufacturing business faces a decision. Should they invest $1 million today in new equipment? To answer this, they need to estimate the future cash flows that equipment will generate and determine if those future benefits justify the upfront cost. The core financial concept here is the time value of money. Time value of money recognizes a fundamental truth. A dollar today is worth more than a dollar tomorrow. Why? Because a dollar today can be invested and earn returns. It can be used immediately. It's certain, whereas future dollars carry uncertainty. When evaluating whether to invest $1 million now for future returns, you must discount those future cash flows back to their present value using an appropriate discount rate. Only then can you fairly compare what you're giving up today with what you'll receive tomorrow. Historical cost tells you what was paid, but doesn't evaluate future returns. Revenue recognition is about when to record sales. Materiality determines what's significant to report. Time value of money is the fundamental concept for comparing today's investments with tomorrow's returns. 17. A financial manager must decide between receiving $50,000 today or $60,000 in 3 years. What calculation approach determines which option creates more value? A. Compound future amount. B. Discount future amount. C. Calculate simple interest. D. Average the amounts. Can you guess the answer? Correct answer, B. Discount future amount. Explanation: option B is correct because discounting brings the future $60,000 back to present value using an appropriate rate, allowing direct comparison with the $50,000 available today. Option A is incorrect because compounding moves present amounts forward to future values, but the decision requires bringing the future amount back to present for comparison. Option C is incorrect because simple interest does not account for compounding effects or properly evaluate the time value difference between immediate and delayed payments. Option D is incorrect because averaging ignores the critical time dimension. $50,000 today is not directly comparable to $60,000 in 3 years without discounting. Here's a classic time value of money decision problem. A financial manager can choose between receiving $50,000 today or $60,000 3 years from now. Which option creates more value? You can't just compare the numbers directly because they exist at different points in time. The answer requires discounting the future amount back to present value. Here's how it works. You take that $60,000 expected in 3 years and discount it using an appropriate interest rate that reflects the opportunity cost of waiting and the risk involved. If you use, say, a 5% discount rate, you calculate what $60,000 3 years from now is worth in today's terms. The formula applies the discount rate for 3 periods. After discounting, if the present value of $60,000 comes out to more than $50,000, take the future payment. If it's less than $50,000, take the money today. Compounding goes the other way, moving present amounts forward. Simple interest doesn't account for compounding effects, and averaging ignores the time dimension entirely. Discounting properly brings future values back to present for valid comparison. 18. A pension fund manager needs to determine how much money is required today to pay a retiree $100,000 in 20 years. What financial calculation would provide this answer? A. Future value. B. Present value. C. Annuity payment. D. Interest accrual. Do you know the answer? Correct answer, B. Present value. Explanation. Option B is correct because present value calculation determines what amount today will grow to $100,000 in 20 years, showing how much the fund needs to set aside now. Option A is incorrect because future value calculates what today's investment will become in the future, not what amount today is needed to reach a future target. Option C is incorrect because annuity payments involve regular, equal-sized periodic payments, not a single lump sum needed today to fund one future payment. Option D is incorrect because interest accrual tracks how much interest accumulates, not the principal amount needed today to reach a specific future value target. Let's tackle a pension fund planning problem. A pension fund manager needs to figure out how much money to set aside today to pay a retiree $100,000 in 20 years. This is asking for the present value. Present value answers the question, what amount today will grow to a specific amount in the future, given a particular interest rate? It's the reverse of future value. If you invest a certain amount now and earn interest over 20 years, it will grow to $100,000. But how much do you need to start with? That's the present value calculation. You take the $100,000 target and discount it back 20 periods using the expected rate of return on the fund's investments. Future value would tell you what today's investment will become, which is the opposite direction. Annuity payments involve regular periodic payments, not a single lump sum target. Interest accrual tracks how much interest builds up, but doesn't tell you the principal needed today. Present value is the specific calculation for determining what amount today will reach a future goal. 19. A business evaluates competing projects by comparing the present value of expected future cash inflows against initial investment costs. What investment evaluation method does this approach describe? A. Payback period. B. Accounting rate of return. C. Net present value. D. Simple return. Can you guess the answer? Correct answer, C. Net present value. Explanation. Option C is correct because net present value calculates the difference between discounted future cash inflows and initial costs, providing a clear profitability measure that accounts for time value. Option A is incorrect because payback period measures how quickly the initial investment is recovered, not the difference between discounted future inflows and initial costs. Option B is incorrect because accounting rate of return uses accounting profits rather than discounted cash flows to evaluate investment performance over time. Option D is incorrect because simple return divides profit by investment without discounting future cash flows, ignoring the fundamental time value of money concept. Now let's understand the net present value investment evaluation method. A business is evaluating competing projects by comparing the present value of expected future cash inflows against the initial investment costs. This is the definition of net present value. Here's the process. First, estimate all the future cash flows the project will generate year by year. Second, discount each of those future cash flows back to present value using the company's required rate of return. Third, sum up all those discounted cash flows. Fourth, subtract the initial investment cost. The result is net present value. If it's positive, the project creates value because the present value of what you get exceeds what you pay. If it's negative, the project destroys value. This differs from payback period, which only measures how quickly you recover your investment without discounting. It differs from accounting rate of return, which uses accounting profits instead of cash flows. And it differs from simple return, which ignores the time value of money completely. Net present value is the gold standard because it accounts for all cash flows, timing, and the time value of money. 20. An investment project shows negative net present value when evaluated at the company's required return rate. What does this result indicate about the project's financial viability? A. Project should be accepted. B. Project creates shareholder value. C. Project destroys value. D. Project breaks even. Do you know the answer? Correct answer. C. Project destroys value. Explanation. Option C is correct because negative net present value means the present value of future inflows is less than the initial cost, indicating the project destroys value rather than creates it. Option A is incorrect because the decision rule states that projects with negative net present value should be rejected because they fail to meet return requirements. Option B is incorrect because negative net present value indicates value destruction, not creation. The project returns less than the required rate and hurts shareholders. Option D is incorrect because breaking even means net present value equals zero. Negative net present value means the project loses money on a discounted basis. This question tests your understanding of the NPV decision rule. An investment project has been thoroughly analysed, and when you calculate its net present value using the company's required return rate, the result comes out negative. What does this mean? Remember, net present value equals the present value of future cash, inflows minus the initial cost. If the NPV is negative, it means the present value of what you'll receive is less than what you're paying today. In other words, the project destroys value. It's not earning enough return to justify the investment. The decision rule for negative NPV is clear. Reject the project. It should not be accepted because it fails to meet the minimum return requirements and will make shareholders worse off. Negative NPV doesn't mean break even, which would be NPV equals zero. It doesn't mean the project should be accepted. That's only when NPV is positive. And it certainly doesn't create shareholder value. Negative NPV is a red flag, telling you to walk away from this investment because it will destroy value rather than create it. 21. A company calculates that a proposed investment has an internal rate of return of 15%, while its required return is 12%. What investment decision should follow from this analysis? A. Reject the project. B. Seek additional funding. C. Accept the project. D. Delay the decision. Can you guess the answer? Correct answer, C. Accept the project. Explanation. Option C is correct because when internal rate of return exceeds the required rate of return, the project generates returns above the minimum acceptable level and should be accepted. Option A is incorrect because rejecting a project that returns 15% when only 12% is required would waste a profitable opportunity that exceeds minimum standards. Option B is incorrect because the analysis already shows the project meets return requirements. Seeking additional funding doesn't address the accept or reject decision based on return. Option D is incorrect because the internal rate of return analysis provides clear guidance. Delaying serves no purpose when the project clearly exceeds the required return threshold. Let's dive into the decision rule for internal rate of return analysis. A company has calculated that a proposed investment project has an internal rate of return of 15%. They also know their required return, the minimum they need to earn on investments, is 12%. Now they face a decision. Should they proceed with this project? The answer comes from comparing these two rates. Internal rate of return represents the actual return the project will generate. The required return represents the hurdle rate, the minimum acceptable return based on the cost of capital and risk. When the internal rate of return exceeds the required return, it means the project is generating more than the minimum needed. In this case, 15% is greater than 12%, so the project exceeds requirements by 3 percentage points. This is good news. The decision rule is straightforward. Accept projects when internal rate of return exceeds the required rate. Reject them when internal rate of return falls below the required rate. Rejecting this project would mean turning down a profitable opportunity. Seeking additional funding misses the point since the return analysis is already complete. Delaying serves no purpose when the numbers clearly indicate acceptance. 22. An analyst determines the discount rate that makes a project's net present value equal to 0. What specific financial metric has the analyst calculated? A. Required return. B. Internal rate of return. C. Cost of capital. D. Risk premium. Do you know the answer? Correct answer, B. Internal rate of return. Explanation option B is correct because internal rate of return is defined as the specific discount rate that makes net present value equal 0, representing the project's actual rate of return. Option A is incorrect because required return is the minimum acceptable rate set by investors based on risk, not the calculated rate that zeroes out net present value. Option C is incorrect because cost of capital is the overall rate a company pays for financing, not the specific rate that makes a particular project's net present value 0. Option D is incorrect because risk premium is the excess return demanded above risk-free rates, not the discount rate that equates present value of inflows with initial investment. This question explores the precise definition of internal rate of return. An analyst is working on a project evaluation and needs to find a specific discount rate. What makes this rate special? It's the discount rate that makes the project's net present value equal to exactly 0. Let me explain what this means. Remember that net present value equals the present value of future cash, inflows minus the initial investment cost. When you calculate net present value, you need to choose a discount rate. Different discount rates give different net present values. If you use a low discount rate, future cash flows are worth more in present terms, so net present value tends to be higher. If you use a high discount rate, future cash flows are worth less, so net present value tends to be lower. Somewhere in between, there's a specific rate where the present value of inflows exactly equals the initial cost, making net present value 0. That specific rate is the internal rate of return. It's not the required return, which is set by investors. It's not the overall cost of capital, which is the company-wide financing rate. And it's not the risk premium, which is the extra return above risk-free rates. Internal rate of return is the rate that zeroes out net present value, representing the project's actual return. 23. A retail expansion project has a payback period of 3 years, while company policy requires payback within 4 years. According to the payback period decision rule, what action should management take? A. Reject the project. B. Accept the project. C. Renegotiate terms. D. seek board approval. Can you guess the answer? Correct answer, B, accept the project. Explanation, option B is correct because the payback period decision rule states that projects with payback periods at or below the predetermined cutoff should be accepted. 3 years meets the 4-year requirement. Option A is incorrect because the project recovers its investment in 3 years, which is faster than the 4-year cutoff, so it meets the acceptance criteria. Option C is incorrect because the project already satisfies the company's payback requirement. There's no need to renegotiate when the investment meets the established criteria. Option D is incorrect because the project clearly falls within policy guidelines with a 3-year payback versus a 4-year cutoff, requiring no special board approval. Here's a straightforward application of the payback period decision rule. A retail company is considering an expansion project. They've calculated that this project has a payback period of 3 years, meaning it will take 3 years to recover the initial investment through cash inflows. Now, the company has a policy that all projects must have payback periods of 4 years or less. The question is simple. Does this project meet the criteria? Absolutely yes. 3 years is less than 4 years, so the project recovers its investment faster than the maximum allowed time. The payback period decision rule states that projects should be accepted if their payback period is at or below the predetermined cutoff. Since 3 years is below the 4-year cutoff, management should accept this project. There's no reason to reject it because it clearly meets the standard. There's no need to renegotiate terms because the project already satisfies requirements. And there's no need for special board approval because it falls within normal policy guidelines. When a project's payback period beats the cutoff time, it's a green light for acceptance. 24. A manufacturing project requires $2 million initially and returns $600,000 annually for 5 years. What investment characteristic does the payback period method specifically measure? A. Total profitability. B. Recovery timing. C. Risk-adjusted return. D. Market value. Do you know the answer? Correct answer, B. Recovery timing. Explanation, option B is correct because payback period measures how quickly the initial investment is recovered through cash inflows, focusing specifically on timing rather than total profitability or returns. Option A is incorrect because payback period only measures when the investment is recovered, not total profits. It ignores cash flows received after the payback point. Option C is incorrect because payback period treats all future cash flows equally without adjusting for risk or discounting, making it a simple recovery timing measure. Option D is incorrect because market value relates to what investors would pay for an investment, not to the timing of recovering the initial capital outlay. Let's clarify exactly what payback period measures. A manufacturing company is looking at a project that requires $2 million up front and will return $600,000 every year for 5 years. The payback period method asks one specific question. How long does it take to get your initial investment back? Let's do the math. After year 1, you've received $600,000. After year 2, you've received $1.2 million. After year 3, you've received $1.8 million. Somewhere during year 4, you'll cross the $2 million mark and fully recover your initial investment, so the payback period is approximately 3 1/3 years. Notice what this metric is measuring. It's measuring recovery timing, the speed at which you get your money back. It's not measuring total profitability because it ignores all the cash flows after payback. In this case, you'd still receive $600,000 in year 5, but payback period doesn't count that. It's not a risk-adjusted return because it doesn't discount cash flows or adjust for risk. And it's not about market value. Payback period is purely about timing. How quickly do you recover your initial outlay? 25. 2 investment projects both have 4-year payback periods, but Project A generates substantial cash flows for 6 additional years, while Project B ends after 4 years. What limitation of payback period analysis does this scenario illustrate? A. Ignores time value. B. Excludes post-payback flows. C. Requires subjective cutoff. D. Assumes equal risk. Can you guess the answer? Correct answer, B. Excludes post-payback flows. Explanation. Option B is correct because payback period only measures recovery time and ignores cash flows occurring after the initial investment is recovered, potentially missing significant long-term benefits like Project A's extra years. Option A is incorrect because while payback period does ignore time value by not discounting, this scenario specifically highlights the problem of ignoring Project A's 6 extra years. Option C is incorrect because although cutoff selection is subjective, this scenario demonstrates the issue of missing valuable post-recovery cash flows, not cutoff determination problems. Option D is incorrect because the scenario illustrates missing post-payback returns, not risk assessment issues. Both projects might have similar risk but different total value. This scenario reveals a critical limitation of the payback period method. Imagine you're comparing 2 investment projects. Both have identical payback periods of 4 years, meaning both recover their initial investment in exactly 4 years. But here's where it gets interesting. Project A continues generating substantial cash flows for 6 additional years after payback, years 5 through 10. Project B, on the other hand, ends at year 4, generating nothing after payback. If you only look at payback period, both projects look identical. They both get a 4-year payback rating. But clearly Project A is far more valuable because it keeps generating money for 6 more years. The limitation here is that payback period excludes post-payback flows. It only cares about getting to the recovery point and then stops counting. Everything that happens after you recover your investment is ignored. This means payback period can make a 10-year cash generator look identical to a 4-year project that stops dead after payback. Yes, payback also ignores time value by not discounting, but this scenario specifically demonstrates the post-payback flow problem. Project A's extra 6 years of cash generation are invisible to the payback period metric. 26. A technology startup needs $5 million for product development and must decide between selling ownership stakes or borrowing funds. What fundamental financing choice does this decision represent? A. Operating versus investing. B. Short-term versus long-term. C. Internal versus external. D. Equity versus debt. Do you know the answer? Correct answer, D. Equity versus debt. Explanation. Option D is correct because the choice between selling ownership stakes or borrowing funds represents the fundamental decision between equity financing and debt financing for raising needed capital. Option A is incorrect because operating versus investing relates to how funds are used, not to whether capital is raised through ownership or borrowing. Option B is incorrect because short-term versus long-term refers to the duration of financing, not the fundamental choice between selling ownership or taking on debt obligations. Option C is incorrect because both options are external financing. The key distinction is between giving up ownership through equity or creating repayment obligations through debt. Here's one of the most fundamental choices in corporate finance. A technology startup needs $5 million for product development. They have 2 options. Option 1, sell ownership stakes to investors, giving up a percentage of the company in exchange for the money. Option 2, borrow the $5 million from a bank or by issuing bonds, creating an obligation to repay with interest but keeping full ownership. This is the classic equity versus debt financing decision. Equity financing means raising money by selling ownership. You don't have to pay it back, but you permanently dilute your ownership percentage. Debt financing means borrowing money that must be repaid with interest, but you retain full ownership and control. This isn't about operating versus investing, which describes how money is used. It's not about short-term versus long-term, which is about duration. And while both options involve external financing, the critical distinction isn't internal versus external. The key difference is ownership dilution versus repayment obligation. That's the equity versus debt choice, one of the most important decisions in corporate finance because it affects control, risk, and returns. 27. A growing company discovers that projected asset requirements exceed available internal resources and existing liabilities plus equity. What financial measure quantifies this funding shortfall? A. Working capital. B. Discretionary financing need. C. Operating cash flow. D. Retained earnings. Can you guess the answer? Correct answer, B. Discretionary financing need. Explanation: option B is correct because discretionary financing need measures the gap between projected total assets and the sum of projected liabilities and equity, indicating external funding requirements for projects. Option A is incorrect because working capital measures the difference between current assets and current liabilities, not the total funding gap for projected asset requirements. Option C is incorrect because operating cash flow measures cash generated from business operations, not the funding shortfall between projected assets and available resources. Option D is incorrect because retained earnings are accumulated past profits, representing one source of funding rather than measuring the total external financing gap. Let's understand a key concept in corporate financial planning. A growing company is planning its future and projecting what assets they'll need to support expansion. They add up all the projected assets, everything from inventory to equipment to facilities. Then they look at their available resources, existing liabilities they'll carry forward, and equity they already have. When they subtract available resources from projected asset needs, they discover a gap. The projected assets exceed what's available. This gap has a specific name: discretionary financing need. The word discretionary is key because management has discretion or choice about how to fill this gap. They could raise new debt, issue new equity, or use some combination. Discretionary financing need specifically measures the external funding shortfall for projects. This is different from working capital, which measures current assets minus current liabilities for day-to-day operations. It's not operating cash flow, which measures cash generated from business operations. And it's not retained earnings, which is just one possible source of funding. Discretionary financing need is the measurement tool that quantifies the total funding gap, requiring external financing decisions. 28. A corporation issues bonds that require regular interest payments and eventual principal repayment. What type of capital does this transaction represent for the company? A. Equity capital. B. Debt capital. C. Venture capital. D. Working capital. Do you know the answer? Correct answer, B. Debt capital. Explanation: option B is correct because issuing bonds creates debt capital. The company borrows funds with obligations to pay interest and repay principal, representing borrowed rather than ownership-based financing. Option A is incorrect because equity capital represents ownership stakes with no repayment obligations, whereas bonds require both interest payments and principal repayment to bondholders. Option C is incorrect because venture capital specifically refers to equity investments in early-stage companies, not to bond issuances that create debt obligations. Option D is incorrect because working capital measures current assets minus current liabilities for operations, not the type of capital raised through bond issuances. This question is about identifying the type of capital raised through bonds. A corporation decides it needs to raise money, so it issues bonds to investors. What exactly are bonds, A bond is essentially an IOU, a promise to make regular interest payments to bondholders and to repay the principal amount when the bond matures. From the company's perspective, this creates an obligation, a liability on their balance sheet. They've borrowed money that must be paid back. This is the definition of debt capital. Debt capital represents borrowed funds with repayment obligations. It's completely different from equity capital, which represents ownership stakes with no repayment requirement. It's not venture capital, which is a specific type of equity investment in startups, and it's not working capital, which measures the difference between current assets and current liabilities for operations. When a company issues bonds, they're creating debt. The bondholders are lenders, not owners. The company must make interest payments on schedule and repay the principal at maturity. This is debt capital, borrowed money that increases the liability side of the balance sheet and creates fixed obligations that must be met regardless of company performance. 29. A company's cost of capital is quoted as 8%. What does this percentage fundamentally represent for the business? A. Tax rate applied. B. Return owed to providers. C. Growth rate expected. D. Inflation adjustment. Can you guess the answer? Correct answer, B. Return owed to providers. Explanation. Option B is correct because cost of capital represents the return percentage that must be paid back to those who provided capital, whether debt holders or equity investors. Option A is incorrect because tax rate applies to earnings, not capital costs. While taxes affect after-tax costs, the cost of capital itself represents required returns. Option C is incorrect because growth rate measures business expansion, whereas cost of capital indicates what must be paid to capital providers regardless of growth. Option D is incorrect because inflation adjustment protects purchasing power, but cost of capital specifically measures the return required by debt and equity providers. Let's decode what cost of capital really means. A company states that their cost of capital is 8%. This percentage represents something very specific. It's the return the company owes to the people who provided them with capital. Think of it this way. If you borrow money from a bank, you owe interest. If investors buy your stock, they expect returns through dividends and stock price appreciation. The cost of capital is the weighted average return you must provide to all your capital providers, both debt holders and equity holders. It's expressed as a percentage because it's a rate of return. An 8% cost of capital means the company needs to earn at least 8% on its investments to satisfy capital providers. This isn't the tax rate, which applies to earnings. Yes, taxes affect the after-tax cost of debt, but cost of capital itself is about returns owed. It's not primarily about growth rate, though the company needs to earn above the cost of capital to grow profitably. And it's not just an inflation adjustment, though inflation is one factor that affects required returns. Cost of capital is fundamentally about what the company owes back to those who provided the money, the return percentage required by capital providers. 30. Two companies have identical before-tax debt costs, but company A has a 30% tax rate, while company B has a 20% tax rate. Which company has the lower after-tax cost of debt? A. Company A. B. Company B. C. Both equal. D. Cannot determine. Can you guess the answer? Correct answer, A. Company A. Explanation. Option A is correct because higher tax rates create larger tax benefits from interest deductions, so Company A's 30% tax rate produces a lower after-tax cost of debt than Company B's 20% rate. Option B is incorrect because Company B's lower tax rate means smaller tax benefits from interest deductions, resulting in higher after-tax debt costs than Company A. Option C is incorrect because different tax rates applied to identical before-tax costs produce different after-tax costs. the 30% rate provides greater tax benefits than 20%. Option D is incorrect because after-tax cost equals before-tax cost times 1 minus the tax rate. With identical before-tax costs, the higher tax rate always produces lower after-tax costs. Here's a revealing scenario about tax benefits and debt financing. Two companies have identical before-tax debt costs. Let's say both are paying 6% interest on their loans, but Company A operates in a jurisdiction with a 30% corporate tax rate, while Company B faces only a 20% tax rate. The question asks, which company has the lower after-tax cost of debt? The answer is Company A, the one with the higher tax rate. This seems counterintuitive at first, but here's the key insight. Interest payments on debt are tax deductible. This means when you pay interest, you reduce your taxable income, which reduces your tax bill. The higher your tax rate, the more valuable this deduction becomes. For Company A, with a 30% rate, every dollar of interest saves 30 cents in taxes. For Company B with a 20% rate, every dollar of interest only saves 20 cents in taxes. So, even though both pay 6% before taxes, Company A's after-tax cost is 6% times 1 minus 0.3, which equals 4.2%. Company B's after-tax cost is 6% times 1 minus 0.2, which equals 4.8%. Higher tax rates create bigger tax shields from interest deductions, resulting in lower after-tax debt costs. 31. A financial analyst evaluates a firm's exposure to market-wide economic risks that cannot be eliminated through diversification. What specific risk measure quantifies this exposure? A. Alpha. B. Beta. C. Standard deviation decorrelation. Do you know the answer? Correct answer, B. Beta. Explanation: option B is correct because beta measures systematic risk, which is the exposure to market-wide factors, like inflation or recession, that affect all companies and cannot be diversified away. Option A is incorrect because alpha measures excess returns above expected levels based on risk, not the exposure to unavoidable market-wide systematic risk factors. Option C is incorrect because standard deviation measures total variability, including both systematic and unsystematic risk, not specifically the undiversifiable market-wide risk component. Option D is incorrect because correlation measures how two variables move together, not specifically a firm's sensitivity to market-wide systematic risk that cannot be diversified. This question explores how we measure systematic risk, the risk you can't diversify away. A financial analyst needs to evaluate a firm's exposure to market-wide economic risks. These are risks that affect the entire economy or market, things like recession, inflation, interest rate changes, or political instability. No matter how much you diversify your portfolio, you can't eliminate these broad market risks. They're systematic because they affect the whole system. The metric that quantifies this exposure is called beta. Beta measures how much a stock's returns tend to move relative to the overall market. If the market goes up 1% and a stock typically goes up 1.5%, that stock has a beta of 1.5. If the market goes down 1% and the stock typically goes down 1.5%, that's also reflected in the 1.5 beta. Beta captures systematic risk sensitivity. This isn't alpha, which measures excess returns above what's expected. It's not standard deviation, which measures total variability, including both systematic and unsystematic risk. And it's not correlation alone, though beta is related to correlation. Beta is the specific measure of systematic risk exposure, showing how sensitive a stock is to unavoidable market-wide movements. 32. A technology firm has a beta value of 1.5 while the overall market beta is 1.0. What does this indicate about the firm's risk profile? A. Less risky than market. B. Equally risky as market. C. More risky than market. D. Risk-free investment. Do you know the answer? Correct answer, C. More risky than market. Explanation. Option C is correct because a beta greater than 1 indicates higher market sensitivity, meaning the firm experiences larger swings than the overall market, making it riskier than average market investments. Option A is incorrect because beta above 1 means the firm moves more dramatically than the market. A beta below 1 would indicate lower risk than the market. Option B is incorrect because equal market risk requires a beta near 1. The firm's 1.5 beta shows it significantly more volatile than the market average. Option D is incorrect because no equity investment is risk-free. Risk-free assets have a beta of 0, not 1.5, and this firm clearly carries systematic risk. Let's interpret what beta values tell us about risk. A technology firm has a beta value of 1.5. To understand what this means, remember that the overall market has a beta of 1.0 by definition. Beta measures how much a stock moves relative to the market. A beta of 1 means the stock moves in line with the market. A beta below 1 means the stock is less volatile than the market. A beta above 1 means the stock is more volatile, more risky than the market. In this case, the firm has a beta of 1.5, which is greater than 1. This tells us the firm is riskier than the average market investment. If the market goes up 10%, we'd expect this stock to go up about 15%. But the flip side is also true. If the market drops 10%, we'd expect this stock to drop about 15%. It amplifies market movements by 50%. So this firm experiences larger swings than the overall market, making it a higher risk investment. It's definitely not less risky than the market. That would be beta below 1. It's not equally risky. That would be beta of 1. And no equity investment is truly risk-free. That would require beta of 0. 33. A corporation needs to calculate its overall cost of capital by combining debt and equity costs weighted by their proportions. What financial metric does this calculation produce? A. Marginal cost. B. Opportunity cost. C. Weighted average cost. D. Sunk cost. Correct answer, C. Weighted average cost. Explanation. Option C is correct because weighted average cost of capital combines the costs of debt and equity financing, weighted by their respective proportions in the company's capital structure. Option A is incorrect because marginal cost refers to the cost of one additional unit, not to blending debt and equity costs weighted by their capital structure proportions. Option B is incorrect because opportunity cost represents foregone alternatives, not the blended rate from combining different financing sources weighted by their use. Option D is incorrect because sunk costs are past expenditures that cannot be recovered, completely unrelated to calculating the weighted blend of debt and equity costs. Now let's understand how companies calculate their overall cost of capital. A corporation uses two sources of financing, debt and equity. Each source has its own cost. Debt costs whatever interest rate the company pays. Equity costs whatever return shareholders expect. But the company needs a single overall cost of capital number to use for evaluating projects. How do you combine these different costs? The answer is by calculating a weighted average. You take the cost of debt and multiply it by the proportion of debt in your capital structure. You take the cost of equity and multiply it by the proportion of equity in your capital structure. Then you add these two products together. This gives you the weighted average cost of capital. The weighting is crucial because if you're 70% debt and 30% equity, the debt cost matters more in the average. This isn't marginal cost, which is about one additional unit. It's not opportunity cost, which is about foregone alternatives. And it's not sunk cost, which is about past expenditures. The weighted average cost of capital blends different financing sources according to their proportions, giving the company a single hurdle rate for investment decisions. 34. a manufacturing firm wants to minimize its overall cost of capital while maintaining financial flexibility. What capital structure adjustment typically achieves this goal? A. Eliminate all debt. B. Eliminate all equity. C. Increase debt proportion. D. Equal debt and equity. Can you guess the answer? Correct answer, C. Increase debt proportion. Explanation. Option C is correct because increasing debt proportion generally lowers the overall cost of capital because debt is cheaper than equity due to the tax deductibility of interest and lower risk for lenders. Option A is incorrect because eliminating all debt means using only expensive equity financing, which increases rather than decreases the overall cost of capital. Option B is incorrect because eliminating equity is not possible as companies need equity, and excessive debt dramatically increases financial risk and costs beyond any tax benefits. Option D is incorrect because equal proportions do not necessarily minimize costs. The optimal structure typically involves more debt than a 50-50 split due to debt's tax advantages and lower cost. This question addresses optimal capital structure. A manufacturing firm wants to minimize its overall cost of capital while maintaining financial flexibility. What capital structure adjustment typically achieves this goal? The answer is increasing the debt proportion. Here's why. Debt is generally cheaper than equity for two main reasons. First, interest on debt is tax deductible, which creates a tax shield that reduces the effective cost. Second, debt holders have priority over equity holders if the company runs into trouble, so they accept lower returns because they face less risk. When you increase the proportion of debt in your capital structure, you're using more of the cheaper financing source and less of the more expensive equity. This lowers your weighted average cost of capital. However, there's a catch. You can't eliminate equity entirely because companies need equity to exist, and too much debt creates financial distress risk. The optimal structure isn't to eliminate all debt, which would mean using only expensive equity. It's not to eliminate all equity, which is impossible and creates extreme risk. And it's not necessarily a 50-50 split. The optimal structure typically involves more debt than equity, taking advantage of debt's lower cost while managing risk. 35. A business evaluates major investments like new machinery, facility expansion, or product line launches. What financial management process encompasses these types of decisions? A. Working capital management. B. Capital budgeting. C. Dividend policy. D. Credit management. Can you guess the answer? Correct answer. B. Capital budgeting. Explanation. Option B is correct because capital budgeting is the process of evaluating and selecting major investments or capital expenditures that require significant resources and affect long-term company performance. Option A is incorrect because working capital management focuses on short-term assets and liabilities for daily operations, not major long-term investments like facilities or machinery. Option C is incorrect because dividend policy determines how much profit to distribute to shareholders versus retain, not how to evaluate major capital investment projects. Option D is incorrect because credit management involves policies for extending credit to customers, not evaluating major capital expenditures like new machinery or expansion projects. Here's a question about identifying financial management processes. A business is evaluating major investments like purchasing new machinery, expanding facilities, or launching new product lines. What financial management process encompasses these types of decisions? The answer is capital budgeting. Capital budgeting is the systematic process of evaluating and selecting major capital expenditures. The word capital refers to long-term assets and significant investments. The word budgeting refers to allocating resources, So capital budgeting is about allocating resources to major long-term investments. These decisions typically involve large amounts of money, affect the company for many years, and are difficult to reverse. That's why they require careful analysis using tools like net present value and internal rate of return. This isn't working capital management, which deals with day-to-day operational assets and liabilities like inventory and accounts payable. It's not dividend policy, which decides how much profit to pay out to shareholders versus retaining for growth. And it's not credit management, which involves policies for extending credit to customers. Capital budgeting is specifically the process for evaluating major, long-term investment decisions that shape the company's future. 36. A retail chain needs to decide whether to open 50 new stores over 5 years. What business finance role primarily addresses this type of strategic decision? A. Applying time value methods. B. Recording financial transactions. C. Ensuring regulatory compliance. D. Preparing tax returns. Do you know the answer? Correct answer. A. Applying time value methods. Explanation. Option A is correct because deciding on major expansion requires applying time value of money concepts to evaluate whether future cash flows from new stores justify the upfront investment costs. Option B is incorrect because recording transactions is an accounting function that documents past events, not a finance role that evaluates future expansion decisions. Option C is incorrect because regulatory compliance ensures adherence to laws, not the strategic analysis of whether expansion projects will create value for the business. Option D is incorrect because tax return preparation is an accounting compliance task, not the forward-looking financial analysis needed for major expansion investment decisions. Let's identify which business finance role addresses strategic expansion decisions. A retail chain needs to decide whether to open 50 new stores over 5 years. This is a massive undertaking requiring hundreds of millions in investment. How do they decide if this expansion makes sense? The answer lies in applying time value of money methods. Finance professionals will project the future cash flows from these 50 new stores over their lifetimes. They'll estimate construction costs, operating expenses, and expected revenues for each location. Then comes the crucial step, discounting all those future cash flows back to present value using the company's required rate of return. Only by applying time value of money concepts can they fairly compare the huge upfront investment with the stream of future benefits. Accounting looks backward at historical data to ensure accuracy and compliance. Finance looks forward, using data to make predictions and strategic decisions. Both stores need to comply with regulations and serve various users, but the scenario specifically highlights the temporal difference. One is recording history, the other is planning the future. This time orientation difference is what fundamentally separates accounting from finance in the business world. 37. A construction project generates uneven cash flows across 7 years, with high returns in years 5 through 7. What net present value advantage makes this method superior to payback period for this scenario? A. Simpler calculation process. B. Considers all cash flows. C. Requires less data. D. Ignores risk factors. Can you guess the answer? Correct answer. B. Considers all cash flows. Explanation. Option B is correct because net present value evaluates all cash flows throughout the project life, capturing the high returns in years 5 through 7 that payback period would miss. Option A is incorrect because net present value requires more complex discounting calculations than payback period's simple addition, making it computationally harder, not simpler. Option C is incorrect because net present value actually requires more data, including all future cash flows and appropriate discount rates, not less data than simpler methods. Option D is incorrect because net present value explicitly incorporates risk through the discount rate selection, rather than ignoring risk factors in the investment evaluation. This question highlights a key advantage of net present value over payback period. Consider a construction project that generates uneven cash flows across 7 years. The cash flows are modest in the early years but become substantial in years 5, 6, and 7. If you use the payback period method, you might find that the project pays back in year 4, and then the method stops counting. All those high returns in years 5 through 7 are invisible to payback period analysis. This is where net present value shines. Net present value considers all cash flows throughout the entire project life. It captures every dollar of cash flow from year 1 through year 7, discounts each one back to present value, and includes all of them in the calculation. This comprehensive treatment is crucial for this project because the best returns come late. Net present value isn't simpler than payback. It actually requires more complex discounting calculations. It doesn't require less data. It needs all cash flows, while payback only needs flows until recovery. And net present value doesn't ignore risk. It incorporates risk through the discount rate. The key advantage here is that net present value considers all cash flows, making it superior for projects with strong late period returns. 38. An investment advisor compares two projects with identical net present values but of vastly different initial costs. What limitation of net present value does this comparison reveal? A. Sensitive to discount rates. B. Ignores project size. C. Requires cash flow estimates. D. Assumes constant rates. Do you know the answer? Correct answer, B. Ignores project size. Explanation. Option B is correct because net present value provides absolute dollar amounts rather than returns per dollar invested, so projects with different sizes can have equal net present values despite different efficiency levels. Option A is incorrect because while net present value is sensitive to rates, this scenario specifically highlights that equal net present values don't reveal which project uses capital more efficiently. Option C is incorrect because requiring estimates is a challenge for all methods, not a limitation specific to comparing projects of different sizes with equal net present values. Option D is incorrect because rate assumptions don't explain why equal net present values don't reveal efficiency differences. The issue is absolute versus relative value measurement. This scenario reveals an important limitation of net present value analysis. An investment advisor is comparing two projects. Both have identical net present values of, let's say, $1 million. But Project A required an initial investment of $2 million, while Project B required $10 million. Both create $1 million in net present value, so by the net present value decision rule, both are acceptable. But here's the problem. Project A created $1 million of value from a $2 million investment. That's a 50% return on investment. Project B created $1 million of value from a $10 million investment. That's only a 10% return on investment. Clearly, Project A uses capital more efficiently. But net present value doesn't reveal this because it provides absolute dollar amounts rather than returns per dollar invested. This is what we mean when we say net present value ignores project size. Two projects with vastly different scales can have the same net present value, but very different efficiency levels. Yes, net present value is sensitive to discount rates, but that's not the issue this scenario highlights. And all methods require estimates, so that's not unique. The specific limitation here is that equal net present values don't tell you which project uses capital more efficiently when projects are different sizes. 39. A pharmaceutical company develops drugs requiring 10 to 15 years before generating revenues. What time value of money principle makes distant cash flows less valuable than near-term returns? A. Liquidity preference. B. Discounting effect. C. Compounding growth. D. inflation adjustment. Can you guess the answer? Correct answer, B, discounting effect. Explanation, option B is correct because discounting reduces the present value of future cash flows, making returns 10 to 15 years away worth significantly less today than equivalent near-term cash inflows. So, option A is incorrect because while liquidity preference explains why people value immediate access, discounting specifically quantifies how much less distant cash flows are worth today. Option C is incorrect because compounding grows money forward in time from present to future, whereas the question asks why distant future flows are less valuable in present terms. Option D is incorrect because while inflation erodes purchasing power, discounting encompasses broader time value concepts beyond just inflation, including opportunity costs and risk. Let's explore why distant cash flows are worth less today. A pharmaceutical company develops drugs that take 10 to 15 years before generating any revenues. They invest millions upfront in research and development, then wait over a decade for payoff. Why are those distant cash flows worth less in today's terms than near-term returns? The answer is the discounting effect. Discounting is the mathematical process of reducing the present value of future cash flows. Here's the intuition. If someone promises to pay you $100 in 15 years, that's not as valuable as $100 today. Why? Because $100 today could be invested and earn returns for 15 years, growing to much more than 100. Also, there's uncertainty about whether you'll actually receive the payment in 15 years. The farther into the future a cash flow sits, the more it gets discounted, the less it's worth today. This is different from liquidity preference, which explains why people prefer immediate access, but doesn't quantify the reduction. It's not compounding, which moves money forward in time rather than bringing future values back. And while inflation matters, discounting encompasses broader concepts, including opportunity cost and risk, not just inflation. 40. A pension fund receives equal monthly contributions that will accumulate over 30 years. What type of cash flow pattern do these regular, identical payments represent? A. Lump sum. B. Annuity. C. Perpetuity. D. Irregular stream. Do you know the answer? Correct answer, B. Annuity. Explanation: option B is correct because annuities involve regular, equal-sized payments at consistent intervals, exactly matching the pension fund's pattern of identical monthly contributions over a defined period. Option A is incorrect because a lump sum is a single payment, not the series of regular, equal monthly contributions described in the pension fund scenario. Option C is incorrect because perpetuities continue forever without ending, whereas the pension contributions have a defined 30-year timeframe rather than infinite duration. Option D is incorrect because irregular streams have varying payment amounts or timing, but the pension fund receives identical payments at regular monthly intervals throughout. Let's identify a specific cash flow pattern. A pension fund receives equal monthly contributions from employees that will accumulate over 30 years until retirement. Notice the key characteristics of this cash flow pattern. The payments are regular, happening every month like clockwork. The payments are equal-sized, the same amount each time, and the payments continue for a defined period, 30 years, after which they stop. This is the textbook definition of an annuity. An annuity is a series of equal payments made at regular intervals over a specific time period. Think of other annuities: mortgage payments, car loan payments, retirement account contributions. They all share these characteristics. This isn't a lump sum, which is a single one-time payment, not a series. It's not a perpetuity, which continues forever without ending. Perpetuities have no defined endpoint, while this pension fund has a clear 30-year timeframe, and it's not an irregular stream which would have varying payment amounts or timing. The regular monthly schedule and identical contribution amounts make this a classic annuity. Annuities are important in finance because they have special formulas for calculating present value and future value, different from lump sum calculations. 41. A business owner can invest in either a corporate bond paying fixed interest or equity in a growth startup. What fundamental investment principle explains why the equity investment demands higher expected returns? A. Diversification benefit. B. Liquidity premium. C. Risk-return trade-off. D. Tax advantage. Do you know the answer? Correct answer, C. Risk-return trade-off. Explanation: option C is correct because risk-return trade-off states that higher-risk investments like growth startups must offer higher expected returns to compensate investors for accepting greater uncertainty compared to safer bonds. Option A is incorrect because diversification benefit relates to spreading investments across assets to reduce risk, not to why riskier individual investments require higher expected returns. Option B is incorrect because liquidity premium compensates for difficulty converting assets to cash, not specifically for the higher uncertainty risk of equity versus bonds. Option D is incorrect because tax advantages might favour certain investments, but the fundamental reason equity demands higher returns is compensation for greater risk, not tax treatment. This question explores one of the most fundamental principles in all of finance, the risk-return trade-off. A business owner is deciding between two investment options. Option 1 is a corporate bond that pays fixed interest. Bonds are relatively safe because they promise specific payments on a set schedule, and bondholders have legal priority if the company runs into trouble. Option 2 is equity in a growth startup. Startups are risky. Many fail completely. Even successful ones can take years to generate returns. There's no promise of payment, no guarantee of anything. So here's the question. If both investments are available, why would anyone choose the risky startup over the safer bond? The answer is that the startup must offer higher expected returns to compensate for the higher risk. This is the risk-return trade-off in action. Investors demand higher potential returns when they accept higher risk. If the startup only offered the same expected return as the bond, rational investors would choose the bond every time because they get the same return with less risk. This isn't about diversification benefit, which is about spreading investments. It's not about liquidity premium, which is about ease of selling. And while taxes matter, the fundamental driver here is compensation for risk. The risk-return trade-off explains why riskier investments must promise higher returns. 42. A software firm evaluates whether purchasing servers or using cloud services for 5 years costs less. What time value application would support this lease versus buy decision? A. Future value of purchases. B. Annuity accumulation. C. Compound interest growth. D. Present value comparison. Do you know the answer? Correct answer, D. Present value comparison. Explanation: option D is correct because comparing lease payments' present value against purchase costs allows direct comparison of alternatives with different payment timing, supporting an informed lease versus buy decision. Option A is incorrect because future value looks forward from today, but the decision requires bringing all costs back to present terms for valid comparison. Option B is incorrect because while lease payments might form an annuity, the key decision tool is comparing present values of lease versus buy options. Option C is incorrect because compound interest grows money forward, but this decision requires discounting various payment streams back to present for proper comparison. Let's tackle a practical time value of money application. A software firm needs server capacity for the next 5 years. They have two options: purchase servers outright for a large upfront payment, or use cloud services with monthly lease payments spread over 5 years. These options have completely different payment structures and timing. The purchase requires all the money now. The cloud service spreads payments across 60 months. How do you compare them fairly? You can't just add up the lease payments and compare to the purchase price, because that ignores the time value of money. The answer is present value comparison. Here's what you do. Take all the monthly lease payments expected over 5 years, discount each one back to present value using an appropriate interest rate, and sum them up. This gives you the present value of the lease option. Then compare this present value directly to the upfront purchase cost, which is already in present value terms. Now you can make an apples-to-apples comparison. Future value goes the wrong direction, moving present amounts forward rather than bringing future payments back. Annuity accumulation is about growing periodic payments, not comparing alternatives. Compound interest grows money forward, but we need to discount backwards. Present value comparison is the tool that makes lease versus buy decisions possible by bringing all costs to the same time frame. 43. A manufacturing business has limited funds and must choose between 3 profitable projects, each requiring different investment amounts. What capital budgeting challenge does this scenario represent? A. Unlimited resources. B. Capital rationing. C. Risk assessment. D. Cost estimation. Can you guess the answer? Correct answer, B. Capital rationing. Explanation: option B is correct because capital rationing occurs when businesses must allocate limited available funds among competing profitable investment opportunities, requiring prioritization despite multiple worthy projects. Option A is incorrect because the scenario explicitly states limited funds, which is the opposite of unlimited resources and creates the need for careful allocation. Option C is incorrect because while risk matters, the scenario's challenge is selecting among multiple projects with limited funds, not assessing individual project risks. Option D is incorrect because the issue isn't estimating costs. It's deciding how to distribute scarce capital among competing projects that all appear financially sound. Here's a common challenge in capital budgeting called capital rationing. A manufacturing business has evaluated multiple investment opportunities. They've run the numbers on 3 different projects using net present value analysis. Good news, all 3 projects have positive net present value, meaning all 3 would create value for the company. Each project looks financially attractive, but there's a problem. The company has limited funds available. They don't have enough money to invest in all 3 projects simultaneously. Project A needs $2 million. Project B needs $5 million. Project C needs $4 million. That's $11 million total. But the company only has $7 million available. They must choose which projects get funded and which ones don't, even though all are profitable. This situation is called capital rationing. Rationing means allocating scarce resources among competing uses. Capital rationing occurs when investment capital is limited, forcing prioritization decisions. This isn't about unlimited resources, that would mean no constraint. It's not primarily about risk assessment, though risk matters in project selection. And it's not about cost estimation difficulties. The challenge is clear. Profitable projects exceed available funds, requiring the company to ration limited capital among worthy investments. 44. A hotel chain evaluates building new properties by calculating whether each location's forecasted revenues and costs over 20 years justify construction expenditures. What financial process does this evaluation exemplify? A. Capital budgeting. B. Expense budgeting. C. Cash management. D. Revenue forecasting. Do you know the answer? Correct answer, AA. Capital budgeting. Explanation. Option A is correct because evaluating major construction investments by comparing long-term cash flows to upfront costs exemplifies capital budgeting, which analyzes substantial investment projects for resource allocation decisions. Option B is incorrect because expense budgeting plans are short-term operating costs, not major multi-million-dollar construction projects analyzed over 20-year horizons. Option C is incorrect because cash management handles day-to-day liquidity and working capital, not strategic decisions about major long-term property development investments. Option D is incorrect because revenue forecasting is one input to the analysis, but the overall process of evaluating major investments against returns is capital budgeting. Let's identify the financial process used for major investment evaluation. A hotel chain is considering expansion. They're looking at potential locations for new properties. For each location, they need to estimate construction costs, which might be $50 million or more per property. Then they forecast the revenues each hotel will generate over its lifetime, let's say 20 years. They also estimate operating costs, maintenance, staffing, everything needed to run the hotel. The question they're trying to answer is fundamental. Will the revenues over 20 years exceed the costs enough to justify building? This is a capital budgeting decision. Capital budgeting is the process of evaluating major, long-term investments to determine which ones should be pursued. The word capital refers to significant assets and investments. The word budgeting refers to planning resource allocation. So capital budgeting means planning how to allocate resources to major investments. This isn't expense budgeting, which deals with day-to-day operating costs like supplies and utilities. It's not cash management, which handles short-term liquidity needs. And while revenue forecasting is one input, the overall process of comparing long-term costs to long-term benefits for major investments is capital budgeting. Hotels, factories, research facilities, any major investment requires capital budgeting analysis. 45. Two firms with identical capital structures and projects face different corporate tax rates. Which firm benefits more from debt financing's tax advantages? A. Lower tax rate firm. B. Higher tax rate firm. C. Both benefit equally. D. Neither benefits. Can you guess the answer? Correct answer, B. Higher tax rate firm. Explanation. Option B is correct because higher tax rates create larger tax deductions from interest payments, so the firm with higher taxes receives greater financial benefits from using debt financing. Option A is incorrect because lower tax rates mean smaller tax deductions from interest, providing less benefit from debt financing compared to higher taxed competitors. Option C is incorrect because different tax rates applied to identical interest payments produce different sized tax shields, making benefits unequal rather than equal between firms. Option D is incorrect because both firms benefit from interest deductibility, but the higher taxed firm captures more value from these tax shields than the lower taxed firm. This scenario reveals an important insight about tax benefits and debt financing. Two firms are identical in almost every way. They have the same capital structure, the same mix of debt and equity. They're investing in identical projects. They're even paying the same interest rate on their debt. The only difference is their location, which determines their corporate tax rate. Firm A operates in a jurisdiction with a higher tax rate. Firm B operates where tax rates are lower. The question asks, which firm benefits more from debt financing? Counterintuitively, it's the high tax firm. Here's why. When a company pays interest on debt, that interest is tax deductible. It reduces taxable income. The higher your tax rate, the more valuable this deduction becomes. Think of it this way. If firm A pays $1,000 in interest and has a 40% tax rate, that interest saves them $400 in taxes. If firm B pays the same $1,000 in interest, but only has a 20% tax rate, the interest only saves them $200 in taxes. Same interest payment, but firm A gets double the tax benefit. Higher tax rates create bigger tax shields from interest deductions. This means the after-tax cost of debt is lower for high-tax firms. So paradoxically, companies with higher tax rates benefit more from debt financing because they get larger tax deductions from interest payments. 46. A grocery chain tracks how quickly customers pay for credit purchases compared to how long the chain takes to pay suppliers. What working capital aspect does this timing relationship represent? A. Asset turnover. B. Cash conversion cycle. C. Profit margin. D. Leverage ratio. Can you guess the answer? Correct answer, B. Cash conversion cycle. Explanation: option B is correct because the cash conversion cycle measures the timing between paying suppliers and collecting from customers, reflecting how efficiently working capital flows through business operations. Option A is incorrect because asset turnover measures sales generated per dollar of assets, not the timing relationship between collecting receivables and paying payables. Option C is incorrect because profit margin compares profits to sales, not the timing of cash movements between receiving customer payments and paying suppliers. Option D is incorrect because leverage ratios measure debt usage relative to equity or assets, not the operational timing of receivables collection versus payables payment. This question explores an important working capital metric. A grocery chain operates on credit terms with both customers and suppliers. When customers buy groceries on credit, the chain doesn't get paid immediately. The money is tied up in accounts receivable for some number of days. Let's say customers take 30 days to pay. On the other side, when the grocery chain buys inventory from suppliers, they don't pay immediately either. The suppliers give them credit terms, maybe 60 days to pay. So the chain receives inventory, sells it to customers on credit, collects from customers, and eventually pays suppliers. The timing of these cash movements is crucial for managing working capital. The metric that captures this timing relationship is called the cash conversion cycle. It measures how long cash is tied up in operations from the time you pay suppliers until you collect from customers. A shorter cycle is better because cash moves through the business faster. This isn't asset turnover, which measures sales per dollar of assets. It's not profit margin, which compares profit to sales. And it's not a leverage ratio, which measures debt. The cash conversion cycle specifically tracks the operational timing of cash movements through the working capital cycle, from paying suppliers to collecting from customers. 47. A delivery company must decide whether to purchase delivery trucks or lease them for 7 years. What financial analysis would best support this decision? A. Profitability analysis. B. Liquidity analysis. C. Present value comparison. D. Market value analysis. Do you know the answer? Correct answer, C. Present value comparison. Explanation: option C is correct because comparing present values of lease payments against purchase costs accounts for different payment timing and amounts, enabling proper comparison of the lease versus buy alternatives. Option A is incorrect because profitability analysis measures earnings generation, not the specific comparison of lease payments versus purchase costs over time for vehicle acquisition. Option B is incorrect because liquidity analysis examines ability to meet short-term obligations, not the long-term cost comparison between leasing and purchasing delivery trucks. Option D is incorrect because market value analysis considers resale values, but the core decision requires comparing present values of lease payments versus purchase outlays. Here's another lease versus buy scenario requiring time value analysis. A delivery company needs trucks to operate their business. They have two options. Option 1, purchase trucks outright, paying perhaps $50,000 per truck today. Option 2, lease trucks for 7 years with monthly payments of, say, $800 per truck. These payment structures are completely different. Purchase means all the money goes out immediately. Leasing means spreading 84 monthly payments over 7 years. How do you determine which option costs less? The answer is present value comparison. You take all 84 lease payments, discount each one back to present value using an appropriate discount rate that reflects the company's cost of capital, and sum them up. This gives you the present value of the lease option. Then you compare this present value to the $50,000 purchase price. Both amounts are now in today's dollars, allowing a fair comparison. Profitability analysis measures earnings generation, not the lease versus buy decision. Liquidity analysis examines short-term obligations, not long-term leasing decisions. Market value analysis might consider resale value, but the core tool is present value comparison. By discounting future lease payments to present value, you can make an apples-to-apples comparison with the upfront purchase cost. 48. An investor evaluates systematic risk exposure before making stock purchases. Which market comparison metric would provide this risk information? A. Price-to-earnings ratio. B. Dividend yield. C. Return on assets. D. Beta coefficient. Can you guess the answer? Correct answer: D. Beta coefficient. Explanation. Option D is correct because beta coefficient specifically measures systematic risk by showing how much a stock's returns move relative to overall market movements, indicating undiversifiable market exposure. Option A is incorrect because price-to-earnings ratio compares stock price to earnings for valuation purposes, not for measuring market-wide systematic risk exposure levels. Option B is incorrect because dividend yield shows income return from dividends, not the stock's sensitivity to market-wide systematic risk movements and economic factors. Option C is incorrect because return on assets measures operational profitability, not a stock's correlation with market movements that indicates systematic risk exposure. Let's understand how investors measure systematic risk before making investment decisions. An investor is evaluating stocks and wants to understand each stock's exposure to market-wide systematic risk. Remember, systematic risk is the risk you cannot diversify away. It's the risk that comes from broad economic factors like recession, inflation, interest rates, and political events that affect the entire market. No matter how well you diversify your portfolio, you're still exposed to systematic risk. The metric that quantifies this exposure is the beta coefficient. Beta measures how sensitive a stock's returns are to overall market movements. If the market goes up or down, how much does this particular stock tend to move? A beta of 1 means the stock moves in line with the market. A beta of 1.5 means the stock tends to move 50% more than the market. A beta of 0.5 means the stock moves half as much as the market. Beta is specifically designed to measure systematic risk. This isn't the price-to-earnings ratio, which is a valuation metric comparing stock price to earnings. It's not dividend yield, which measures income return, and it's not return on assets, which measures operational profitability. Beta coefficient is the specific tool for measuring how much systematic risk a stock carries relative to the overall market. 49. A financial manager finds that a proposed expansion project has an internal rate of return below the company's cost of capital. What does this finding indicate? A. Project exceeds requirements. B. Project meets minimum standards. C. Project fails to meet requirements. D. Project needs more analysis. Do you know the answer? Correct answer: C. Project fails to meet requirements. Explanation. Option C is correct because internal rate of return below cost of capital means the project doesn't generate sufficient returns to cover financing costs, failing to meet minimum acceptable investment standards. Option A is incorrect because returns below the cost of capital indicate underperformance, not exceeding requirements. The project fails rather than surpasses minimum return standards. Option B is incorrect because meeting standards requires internal rate of return at least equal to cost of capital. Falling below this threshold means failing to meet requirements. Option D is incorrect because the analysis provides clear guidance. When internal rate of return falls below cost of capital, the decision is straightforward rejection without further analysis. This question tests understanding of the internal rate of return decision rule in relation to cost of capital. A financial manager has analysed a proposed expansion project and calculated its internal rate of return. Let's say the internal rate of return came out to 8%. Now the manager compares this to the company's cost of capital, which is 10%. Cost of capital represents what the company must pay to finance the project, the return required by debt holders and equity holders. Internal rate of return represents what the project actually generates. When internal rate of return is below cost of capital, it means the project doesn't generate enough return to cover its financing costs. The project earns 8%, but costs 10% to finance. That's a 2% shortfall. This is a losing proposition. The decision rule is clear. When internal rate of return is less than cost of capital, reject the project. It fails to meet minimum requirements. This doesn't mean the project exceeds requirements that would require internal rate of return above cost of capital. It doesn't meet minimum standards that would require internal rate of return equal to or above cost of capital. And it doesn't need more analysis. The numbers are clear. The project's returns don't justify its costs, so rejection is the appropriate decision. 50. A business evaluates financing alternatives and discovers that debt capital provides tax benefits while equity capital does not. What accounting principle explains this difference? A. Matching principle. B. Interest tax deductibility. C. Revenue recognition. D. Conservatism principle. Can you guess the answer? Correct answer. B. Interest tax deductibility. Explanation. Option B is correct because interest payments on debt are tax-deductible expenses, reducing taxable income, while dividend payments to equity holders are paid from after-tax profits without tax benefits. Option A is incorrect because the matching principle aligns expenses with related revenues in the same period, not the differential tax treatment between debt interest and equity dividends. Option C is incorrect because revenue recognition determines when to record sales, not why interest payments receive tax benefits that dividend payments to equity holders do not. Option D is incorrect because conservatism guides reporting caution with uncertain items, not the tax code's treatment allowing interest deductions, but not dividend deductions for companies. Our final question addresses why debt and equity have different tax treatments. A business is comparing financing alternatives. They notice something interesting. When they pay interest on debt, they get a tax deduction. But when they pay dividends on equity, they don't get a tax deduction. Why this difference? The answer is interest tax deductibility, a specific provision in the tax code. Here's how it works. Interest on debt is considered a business expense, just like paying rent or salaries. Because it's an expense, it reduces taxable income. If a company has 1 million in operating profit and pays 200,000 in interest, they only pay taxes on 800,000. The interest is deducted before calculating taxes. Dividends, however, are not considered a business expense. Dividends are distributions of after-tax profit to owners. The company must first pay taxes on its profit, and only then can it distribute dividends from what's left. This creates a tax advantage for debt financing. This isn't the matching principle, which is about timing expenses with revenues. It's not about revenue recognition, which determines when sales are recorded. And it's not the conservatism principle, which guides cautious reporting. Interest tax deductibility is the specific accounting and tax treatment that makes debt financing attractive by providing tax benefits that equity financing doesn't offer. You have reached the end of our first question set. For the free complete exam preparation, visit our website link in the description, where you find thousands more practice questions and comprehensive study guides. Thanks for studying with us today. See you in the next video.